fascinating world of accounting, where numbers dance in harmony, weaving the intricate tale of financial narratives.
Accounting, often regarded as the art of financial storytelling, goes beyond mere calculations.
It unveils the heartbeat of businesses through balance sheets, income statements, and cash flows.
As we embark on this journey, boys and girls, keep in mind that the company's Act and accounting standards function as a guiding script, ensuring the authenticity and transparency of every chapter in the compelling saga of financial management.
Let's navigate the language of financial numbers with the help of our paper presenters for the day.
We request CA Tuppad Virupaksha, SICASA Chairman of Bengaluru, to escort CA Rajavardhan and paper presenters Sri Gauri TR, Parjanya Acharya and Sudarshan Iyer onto the dais. A huge round of applause, ladies and gentlemen. Sir. Token of gratitude. I request CA Tuppad Virupaksha, SICASA Chairman of Bengaluru branch of SIRC of ICAI, to welcome them with a token of gratitude. A round of applause, ladies and gentlemen. Thank you so much, sir. Ladies and gentlemen, we have with us our session chairman. Start.
Ladies and gentlemen, we have with us CA Rajavardhan, the chairman for this session. CA Rajavardhan A is a partner at Pathi Rajavardhan & Co. Trainers for CA students for over 8 years across cities in South India. He is a career counselor and gives sessions across the country guiding thousands of young minds. Having visited 17 states and 5 union territories on work and travel, is an adventure enthusiast with license in open water diving. Certified in skiing and high altitude trekking. He was also awarded as Sakhat Bangalorean title by TCS in 2014.
May we now request CA Rajavardhan, the chairman for this session, to address the gathering and set the context for the session. A huge round of applause, ladies and gentlemen. Here we present CA Rajavardhan.
Yes, I didn't intentionally talk for last 10 seconds. So what didn't come out of my mouth is the sound. And what didn't resonate from my mind is the sound. And what didn't get into your ears is the sound. And that's the topic for our entire mega conference that we're having this year, Dhwani. That's the significance of the resonance that appears in our mind, which transmits out of my mouth into your ears and connects me to your mind to make you understand what I'm trying to communicate. And today, when I walked in here, it took me back to 2008 and 2010, 2 years where I applied as a student speaker and I got royally rejected. And today I'm really happy to be called as a session chairman to head this particular session. And as we are born, for the first few years of our life, we learn how to talk and how to walk. For the rest of the life, we'll be thinking where to walk into and how to talk and what not to talk. For the last decade, I've been asking people to shut up and sit down, don't talk and don't walk and listen to me. But today I'm here to sit and then listen to these beautiful people here who worked really hard in working on their paper. I can tell that before you people because I've looked into their presentation several times before today's session. So, lot of effort has gone in, lot of research is being done by these young minds who are from your peer group to make this session very informative to you people. The next 45 minutes, what you see is not going to be just 45 minutes. It is about a week or more of effort from these people out of their regular routine work of office, studies, and their also regular life beings like friends and then family that they do have. And I really like the topic that we're starting with today, accounting, the story or the, so to say, the financial storytelling. The evolution of mankind is best understood by the evolution of accounting. Starting from the times where people were early men and they were writing on the caves to the times where we don't even have to write and then sit and make everything over Excel sheet and then sign it just because we know how to sign. Accounts has evolved us. And the word accounting itself says that it is a count of things and keeping track of things, and we have never been behind and keeping track of anything that comes around us. The word accounts is something that we've been dumped with, is what I usually tell. Starting from the time when we wake up in the morning to the time we sleep. Like a great man once told in one movie, if you remember, like pen ki nib se pan ki zip tak hum machine se kade hue. Similarly, in accounting term also, the moment you wake up in the morning, where you start with your Instagram status, the day you end your day, going through some ledger account of your client or preparing for tomorrow's test by solving a problem from your notebook. We've been flooded with accounts. And today we have with us Sri Gauri, who's going to take us from the entire journey of accounting, from the time the father of accounting was born to the modern times where some of us are scared if AI will take over our jobs. Do you really think AI will take over our jobs? Okay, I will not answer this question to you because Sri Gauri has the answer ready and she'll put it across way better than what I'm going to do. And after that, we were early men, we never had any laws regulating us. We were bound by our own rules. We could wear what clothes we wanted to wear, we could eat whatever we wanted to eat. Starting from those times, evolving into sole proprietorship concerns, now venturing into the state of business where everything is regulated by act and law. Every section that comes up in every law is because of some misrepresentation someone did before and some cheating someone did before, which we really think is deceiving against the national interest. So every section, every clause, every provision that is there in the act is because of some act that has happened in the past. So here to help us is Parjanya, who's going to walk us through Companies Act, Accountant Audit, how relevant is it today, and is going to bring in a couple of very interesting case laws also to make us understand the entire thing. I'll not spoil the entire session for you for by telling what exactly is the topic that is going to talk about. And on the closing remarks, there is huge amount of comparability that should come in to ensure that we make best decision out of the results that we have. But what lacks is reliability, what we lack is comparability, what we lack is non-standardization. That's where the bird with two wings, which flies beyond the problems, beyond the rains, way above the clouds to find the solutions. Our institute came into picture with Accounting Standard Board issuing accounting standards. In the global outset also, we have several bodies which do issue accounting standards. We have International Accounting Standard Board, we have International Financial Reporting Interpretation Committee, and we have with us Sudarshan, who's going to walk us through as to how do we standardize the global outset, and like I mentioned before, how is it that every standard is related to some kind of scam that walked into us before. I promised you that the session is not going to be boring at all because they're not here to state some clauses, state some paragraphs of the standard, but he's going to talk from the root cause problem, taking you all the way back to 2008 when all of you people were still in cradles, if I'm not wrong. So picking up the problem from 2008 and bringing it to the present date and helping us all understand what is the reason why the standard is this way. And I hope you people will stay glued to your seat and enjoy the rest of the session and enjoy this great hard work of all of these people who prepared with great amount of time going in for this presentation. And I'll meet you all towards the end for my closing remarks. So without further ado, I'll share my mic with the MCs to call upon your speakers for the day. Thank you, guys.
Thank you so much, sir, for those words of wisdom.
Ladies and gentlemen, we have with us Sri Gauri TR, our first paper presenter for the day. Sri Gauri TR, a CA student hailing from a small town called Tarikere in Chikmagalur district of Karnataka. She is pursuing her articleship at Suri & Co. Chartered Accountants, Bangalore. Shri Gauri has presented papers earlier on standards on auditing and forensic audits. In addition to the above, she has been runner-up at national level extempore contest conducted by Board of Studies ICAI as part of National Talent Search Program. She has also been amongst the top 10 speakers in the regional level elocution competition conducted by Board of Studies ICAI. She is an eloquent orator and has a deep connection with Mike. In addition to all of the above, she is a Bharatanatyam dancer and a performing artist and a forever enthusiastic of knowledge and wisdom. Ladies and gentlemen, give it up for my ex-PRO, Shri Gauri TR.
Aditya.
Please make note, paper presenter, your time limit is minimum of 10 minutes and maximum of 15 minutes. The timer card, Jatar? Yes, the timer card is up there. You will be shown yellow card at 12 minutes and red card at 15 minutes. Please make note, yellow card at 12 minutes and red card at 15 minutes. All the best paper presenters. Give a huge round of applause for them, ladies and gentlemen.
Hello. Check. Yeah. Thank you, Aditya. Good afternoon, everyone. Come on, I do understand that you people listen to a lot of speeches, but you have to be energized because it's the first day, first show. So once again, good afternoon, everyone. Thank you so much. I am Shri Gauri TR. Today, I will be taking you all through the art of financial storytelling, making balance sheet come alive, the evolution of accounting from abacus to AI. Looks like a big statement, right? Let's decode it. Let's understand it. Before that, we'll see. Powerful people make places powerful. Are you aware of this statement? Where did you all come across this statement? Of course, you're all absolutely right. This statement is taken from the movie KGF. Of course, this was the statement which was made for Rocky Bai. And now comes the next one. I love you 3000, and this is taken from? Of course, you all will know, you all have watched Tony Stark and applauded him. And then comes the actual statement. A person should not go to sleep at night until the debits equal the credits. Now tell me who made this statement. I know your minds are telling that it is your principal, but tell me in reality who made this statement. Anybody in the crowd? Okay, let me answer for this question. It is Luca Pacioli, the father of modern day accounting. And now, why I am talking about the father of modern day accounting? Because today we all are here to know the story of accounting. The topic itself has two narratives. The story a balance sheet narrates and the story of balance sheet and accounting in itself. So what are those things that I'm going to cover in my presentation today are this. I'll give a brief introduction to my topic. We'll have a look at the history of accounting, the balance sheet in early 20th and 21st century, the future of accounting and balance sheet. Of course, many of the speakers earlier this morning mentioned about this aspect. And let's all try and get some inferences from all the above thing and conclude. It is as simple as that. It's going to be interesting, and let's start. So, introduction to balance sheet. You know, I mentioned about Luca Pacioli. So, where did Luca Pacioli come from? Now, I'll make a statement. Let me see how many of you in the crowd can recall the statement? When Ottoman Turks conquered Constantinople in 1494, anybody can recall this statement? Okay, that's why we all are here as started accountancy students, because this is a statement in our history textbook of 8th standard where we learnt about a period called Renaissance. Renaissance led to birth of lot of painters, artists, but there was one person who laid foundation for accounting, and that is Luca Pacioli, a mathematician. In his book Summa de Arithmetica, mentioned about double entry system of accounting on which the entire planet's financial system is standing on for years now. From those days of palm leaf balance sheet to this day where we are reporting financial statements in XBRL format, balance sheet has evolved a lot and is keep on narrating a lot of stories. Let us now travel to the times of Luca Pacioli and just have a glance what made this accounting and balance sheet to come into world. So in 1494, when the Ottoman Turks conquered Constantinople, I know this is not a history class, but history is very important. Like the speaker in the morning stated, there was a need for accounting. Why? Because there was increased commercial activity due to Renaissance, and there was wealth accumulation consequently because of increase in commercial activity. And when wealth started accumulating, in order to maintain that, there was integration with humanism. In such a situation, the mathematicians in that era came up with a simple, wonderful tool called abacus. The moment I say abacus, I know all of you will recall that classmate of yours who used to do calculations in hand, some gestures, we used to wonder, some used to laugh, but that was the tool which was used back then to do all this calculation. How did this abacus help in accounting? Let's have a look now. Abacus help in tallying records, maintaining records. It is little weird for us to think of those pearls and wooden sticks. How did it even help in recording transactions when we are all in the era of automation? But it's the truth. They then used abacus to record transactions. Then they also used abacus for currency conversion. International trade is not something which we are seeing today. It is there from 700, 800 and millions of years ago. We are seeing there is international trade, and hence they used abacus in currency conversion and also tallying transaction. When double entry came into picture, the debits should be equal to credits. That's how they used abacus to tally transactions. And then comes a period, quick jump to 200 years from Renaissance. There came Industrial Revolution, where the manufacturing entities saw a lot of boost, and that's when the computerization of the accounting happened. Till then it was all manual, it was all recorded in paper, pen or whatever, palm leaves. Then came computerization. UNIVAC system was the first computer which was made to process this large number of accounting transactions. So Industrial Revolution made a need for coming up with financial statements. Why? As manufacturing increased, there was a demand for tracking the business, and hence there was a need for financial reporting. When there came a need for financial reporting, the computerization of accounting came in rescue. It helped in recording every transaction and keeping a proper track of it. Now I spoke a brief history, what led to the birth of accounting. Now let's directly jump to India and see what happened to accounting and balance sheet, which is the main element of this accounting in the early 20th century. So in early 20th century, what happened is the statutes started coming into place. First, it was just to record entries. Later, it was to maintain some track during industrial revolution. And then when the industry started booming, there was a necessity for regulating all these financial activities. And then came statutes, and then became the computerization of the business languages, and we moved from manual to automation of the entries. Now for the present day scenario, I will run you all through the Companies Act of 1913, 1956, 2013, only in perspective of a balance sheet, just to make a note how balance sheet has evolved from that time till date. I'm very sure after looking at the balance sheet of some of the statutes, you will really feel, why don't I have that act now, and why I'm studying 2013 act. You know why? Have a look at this now. So this was the balance sheet format under 1939 Act. Can you see? It is as simple as it can be. To make it more visible to you, let me just zoom in. So we have capital and liabilities, only few items, only 3 items, done and dusted. Not like n number of items and we keep trying to tally and it never does. It is just simple capital, liabilities showing the number of shares, liabilities, close. And when we move ahead to fixed assets, it is also very simple as it can be. Immovable property, movable property, and leasehold property. That's it. And we are done with the balance sheet format of 1939. I know most of us are thinking why I'm not studying this instead of 2013. But as we move ahead, things just get complicated and not easy. It's in our hands how to make easy. So, in order to understand how the balance sheet has evolved in 21st century, we had a look at the balance sheet in 20th century. To see how it evolved in 21st century, I'm going to take an example of the financial statement of a company. I know balance sheet has its own phase and structure in each form of business, but I am concentrating purely on a company right now. So, I'm taking the example of this particular company, which has been pretty much in history of India, in present day of India, and definitely going to be future of India. Which is that company? I want you all to guess.
क्या खरीदूं ये बताओ।
चलो टाटा का कोई भी शेयर। ज्यादा सोचो मत, पुरानी कंपनी आज नहीं तो कल फायदा ही देगी।
खुद नए में पैसा डाल के गाड़ियां खरीद रहे और हमको बोल रहे कि पुराना उठाओ। क्या
बात नहीं यार सब। ठीक है, तुम भी डाल दो नए में। नुकसान हुआ तो तुम्हारा चलेगा।
नहीं नहीं, ऐसे कैसे चलेगा?
So here, a man is asking for suggestion. And the classic suggestion what Harshad Mehta has to give is Tata's. He's telling, it is an old company and you have to invest in this company. Guys, that is the history that Tata has. What better than Tata company's balance sheet to understand the evolution of balance sheet itself? So here is the balance sheet annual report of Tata for the year 2006. Let us see how was the balance sheet in 1956. When it comes to 1956, it was source of funds and application of funds. As simple as that, shareholders fund and application of the same fund, simple. And when we go ahead in fixed assets, we have gross block, net block, investments, inventories, simple as that. Then comes the reality what we all are studying today, that is the Companies Act of 2013, Schedule 3. This is the balance sheet of Tata's as on March 31st, 2023. Here you can see a lot of items is getting added. So this is the look of assets where we can see current and non-current items, and we can also see equities and liabilities and current liabilities. You all know this better. I know you all have studied for exams. Why I'm showing this particular element is, you can observe the difference from 1913 Act till 2013 Act, how balance sheet has evolved. This is the story of balance sheet. Well, what is that story that balance sheet is trying to narrate us? To keep it simple, shareholders fund tells the story of the trust people have in a company. Fixed assets narrates the story of the strength that a company has to continue for a longer time. Liabilities shows that the company is acknowledging its obligations to its investors. This is the story a balance sheet is narrating. I know you can't write all these things in exams, but this is the story a balance sheet narrates. There is a story hidden in this logical wonder called accounting. We all saw the history and present how it is going, and we all now have a big question mark in our mind. What is going to happen to us or to accounting in future? In fact, it's high time that we all should realize that the future is already here, and we are already living in the generation of open AI and ChatGPT. The stories narrated by this logical wonder is going to get a different narrative because of artificial intelligence. Then how it would be during the era of artificial intelligence? Let's just take a glance at this.
Upskill for the future?
This new AI can perform all coding jobs in seconds, including blockchain development. While this AI is already outperforming accounting firms. Meanwhile, the new graphic design AI aims to automate graphic design and could minimize the need for...
Relax.
Well, relax guys. It is not a threat to our job. We are still in the future. We are going to ace this, because if human can invent something called ChatGPT, his brain is way more ahead of artificial intelligence. Today, we see artificial intelligence is being used in ERP system to automate the daily activities. We also see AI is being used in business reporting as well. There are some key elements or key advantages that AI gave. That is, it helps in automating the routine task accounting or a finance team does in a company. It also helps in advanced analysis of data. It also helps and assists in dynamic and interactive visualization of the data which we get in bulk from our client. And then it also establishes a smart contracts for financial transactions. These are some really just 0.5 advantage of artificial intelligence. There are some key tools of artificial intelligence which assist in doing all these things. Blockchain is just like a secured ledger which keeps all your transactions safe and sound. Cloud computing, I know most of you all are aware and are using this, where you just save all your data in a cloud-based memory. Internet of Things, it is something like where you have a piggy bank, you put money, it itself records how much is there, how much is spent in itself. That's how Internet of Things will work. And natural language processing. This is something very interesting. When you narrate a transaction in your own language, AI in itself process it to a business transaction and record the entries. This is just a minute example what an artificial intelligence can do to accounting and balance sheet in future. So, history is who we are, why we are, and where we are, and the way we are. Future is what we are going to be. After listening to the history, present, and future of accounting, we all should try and draw inferences that we are yet to evolve a lot. We have come a long way. There is a longer way to go, and what better than chartered accountancy to experience this journey of logical wonder called accounting. Thank you so much for your patient listening. This is Sri Gauri TR signing off, and if you are interested in knowing more, you can all refer to the Companies Act and to various research papers on accounting online. Thank you so much.
Thank you so much, Sri Gauri, for helping us giving a better understanding of the topic.
Our second paper presenter for the day is Parjanya Acharya. He is currently navigating the dynamic realms of business consulting as an article at EY. His professional journey has been defined by an insatiable interest in investment banking. Beyond the boardrooms and financial models, his passion extends to the world of sports. As a resilient CrossFit athlete and a professional badminton player, he thrives on the discipline that sports demand. He believes that the skills honed in the sporting arena seamlessly translate to the intricacies of the financial world, fostering a holistic approach to both his personal and professional growth.
Ladies and gentlemen, give it up for our second paper presenter for the day, Parjanya Acharya.
Hello? 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 Well, what if I said that Companies Act 2013 is a classic Aliya Allah Magalganda of the 1956 Act? Shocking, isn't it? Well, not really. And this is going to be our agenda for the next 15 minutes. Ladies and gentlemen, for starters, it's important for us to understand that Companies Act 2013 was not born out of thin air. So earlier, there was a period where companies were similar to bubbles, right? They formed fast, but they broke even faster. And this trend was completely demolished by something called a Bubbles Act in 1720, right? So, and then came the English Companies Act in 1844, and then our Desi version in 1956, right? Moving on. Well, in an era where guys find it hard to attract one woman, this respected gentleman here attracted several of them. Not women, but sections of the Companies Act. So before we dive deeper into this concept, it becomes important for us to understand a little context of a public issue earlier. So earlier what companies did was, in order to raise money through a public issue, they had to make certain significant disclosure agreements. And in that significant disclosure agreements, they had to disclose about their promoter holding, financial statements, current state of affairs, and the nature of business, right? Well, we Indians, as the saying goes, we like to exploit every loophole in any act so possible. So be it even in the Companies Act, we didn't spare Companies Act. So what we did, we found a bypass route. Well, the bypass route of avoiding all of this documentation was to raise money through making multiple preferential allotments or private placements, right? But the icing on the cake was, even for this, there was no limit on the number of people those preferential allotments could be made to, right? However, in 2000, Companies Amendment Act came out with a banger. It said they actually put a numeric threshold to the number of people to whom such preferential allotments could be made. Well, jumping on to what Sahara did, Sahara issued something called an OFCD. Let's understand what OFCD is. It translates to optionally fully convertible debentures, right? They floated around 19,400 crores worth of debentures with approximately 2 crore investors, right? And in their RHP, anybody knows what RHP is here? Red herring prospectus, bang on. So the statings that Sahara made was they had no intention to list their securities on a recognized stock exchange. That was number one. Number two, the funds raised were to be used to acquire townships and residential complexes. And number three, they wanted to waltz into the energy transmission business. Well, SEBI, out of nowhere, came out with a banger again. So it made an accusation against Sahara that the nature of the issue was that of a public issue, and therefore they had to comply with all the documents that I just told you, right? But Sahara, being Sahara itself, a big, huge, major corporation, stood for itself. So how did it stand for itself, right? Sahara made it very clear that it issued to persons associated to Sahara Group itself, associated to Sahara Group as in friends, families, and associates, right? And also they made it very clear that these optionally fully convertible debentures were in the nature of hybrid securities, which were not included in the definition of securities under SEBI Act. All right, and therefore, section 67 and 73 of the Companies Act would not be made applicable. However, SEBI, justified itself by claiming that these OFCDs were within the ambit of the definition of securities under section 2H of the Securities Act. And also they made it very clear that OFCDs were hybrid securities and therefore they fell within the ambit of quote unquote debentures. And therefore SEBI made it very clear that Sahara had to comply with section 67 and 73 of the Companies Act, and then came into being the concept of deemed public issue. Well, this is very interesting, right? Raju wrote a letter to the board admitting to a massive financial fraud that was taking place in his company. He admitted to overstating his revenues, profits and assets. So effectively what he was doing was he was cooking his books as to make the company look more successful than it actually was. Guys, let's not pretend we all have no clue the scam I'm talking about. Hang on. Well, PwC happened to be the auditors of Satyam for 8 freaking years, ladies and gentlemen. In an era where marriages don't last for even 1 year, this couple made it for 8 years. Imagine the kind of relationship they would have developed over the 8 years. However, PwC was accused of being an ally in the scam because it was proved that PwC failed to undertake its obligation in evaluating the financial statements of Satyam, and therefore it couldn't discover any fraud. It was also proved that PwC violated multiple auditing standards in addition to going against the major ethical code of conduct. So this was about Sahara, guys. Well, this amendment, introduction of Auditel, I'm sure most of you know this, right? So this amendment, I would like to call it as a classic case of government micromanaging companies. Let me tell you why. So earlier, companies could pass adjustment entries even after the year ended, right? So basically, they could book additional expenditure, they could book additional revenues, they could usually change X figure into Y, until it was noticed by the government, right? The government noticed that crores together worth of money was being laundered and adjusted. So therefore, then came the introduction of audit trail, which basically said in layman terms that any transaction recorded will have a very solid source data. So basically, regulators, if they wanted to verify the company's financial statements, they could easily get every transaction ever adjusted along with the timestamp. So this made the amendment so critical. Well, NAFRA, with the introduction of NAFRA, guys, this has got to be one of the most brutal decisions ever taken by the management against fraudulent auditors. Let me tell you why. Well, number one, NAFRA was an independent regulator and it did not need any parliamentary nod. Therefore, it had sweeping powers to act against fraudulent auditors and auditing firms that helped the economic offenders, right? And also, what NAFRA was seen as a watchdog, all right? So basically, ICA had certain powers before the introduction of NAFRA. So ICI was the one to actually govern and discipline the auditors in certain matters. However, after NAFRA came in, it kind of waltzed into the territory of ICAI. But let me tell you, NAFRA was a mere result of Nirav Modi PNB scam, because that scam happened because of the failure of the auditors, right? So that scam happened in 2018 in the month of January. As a result, NAFRA was introduced in the same year, but in the month of October. Well, section 144, right? So earlier, there was no clear distinction as to what an auditor, what the services rendered by an auditor were, if they were legitimate or not. All right, so basically what I essentially mean is an auditor could make the books in certain cases and also verify the financial statements. This is basically like telling a CA intermediate student to write a CA intermediate exam and verify his answer script. His or her, they or them. Thank you. And this, ladies and gentlemen, so however, yeah, so after the introduction of section 144, it was made very clear that, you know, a very clear distinction was drawn and the ambit of the services provided by an auditor was very well defined. And therefore, so this was basically to kind of emphasize on the independence of an auditor and transparency, keeping in mind the corporate governance. This is interesting, guys. So earlier, what used to happen was companies, so lately so in this era, there is ever evolving digitalization, right? And transparency has taken a center stage. Let me tell you why. Lately, all these portals have been interlinked, as you guys know, most of your articles, and I'm sure you guys know that, right? So for example, if a supplier files GSTR1, it gets auto-populated in the recipient's GSTR 2A, 2B, right? And similarly, this is obviously reflected even in the IT department's portal in the form of sales and purchases made by both the parties. So there is no way that these parties can escape, right? Another classic example with respect to the Companies Act is the XBRL reporting that my friend Sri Gauri just mentioned, right? So a certain company satisfying certain criteria must comply with the XBRL reporting standards. So what this essentially does is every company must file their annual returns, annual filings on the XBRL mode. So what this does is it gives the government visibility with respect to how a company is doing, right? But so when a government knows how a company is doing, obviously in totality it gets an idea about the entire sector as a whole. So therefore they can make policy reforms, right, with respect to the circumstance. Well, way going forward, Companies Act stands as a cornerstone in shaping the landscape for both accounting and auditing professions. And Companies Act also addresses the ever-changing business environment in significant emphasis to mainly three things: corporate governance, investor protection, and transparency. Ladies and gentlemen, with this, we come to an end. And before I take off, I'd like to leave the audience with just one question. Does the word reasonable assurance stand relevant today? Thank you so much, ladies and gentlemen. It's been a pleasure. Hope you guys liked it. I know it's lunchtime, but thank you so much for staying in. Signing off, this is Parjanya Acharya.
Thank you, Parjanya, for the insights on such an interesting topic.
Ladies and gentlemen, now we have the final paper presenter for technical session 1. Give it up for Sudarshan Iyer. Sudarshan Iyer is pursuing CA finalist and doing articleship in business consulting practice at EY. He is an avid public speaker, national level parliamentary debater and quizzer. And his hobbies also include reading and playing sports. Ladies and gentlemen, give it up for Sudarshan Iyer.
ನನ್ನ ಧ್ವನಿ ಕೇಳಿಸುತ್ತಿದೆಯಾ? Okay.
Society is a hypocrite. Let me tell you why. They say accounting as a field is very boring, lack of creativity. But when accountants become creative, they send us to jail. They call it a scandal. So on that note, I'm Sudarshan. I'm going to be talking about accounting standards, right? So these are my contents. So what are accounting standards? Accounting standards are basically a set of principles and procedures that tell you what to do. So as we live in a society, society has certain norms, and when it comes to professions as well, these norms apply, right? So in the early 20th century, there was just generally accepted accounting principles, which later evolved into particular standards as companies became bigger stakeholders in the society, right?
Now, what do standards do? Standards basically recognize, measure, present and disclose the assets and liabilities they are relating to, right? It's very simple. Who are the regulators involved? At least in India, ICAI has ASB. Then these standards are later implemented with the consultation of NFRA by the MCA, and internationally the IFRS is initiated by the IASB, while US GAAP is initiated by FASB, right? Next slide. So this is the timeline. In the timeline, in 1973, IASC was formed, where 80 countries came together. In 1977, ICAI formed the ASB. In 2001, due to structural changes, IASC became IASB. In 2016, we brought in Ind AS to India, right? Convergence. So why is there a requirement to bring Ind AS, that is basically IFRS, into India? Because of globalization and liberalization, as more companies are investing in India, we need enhanced transparency and comparability and things like that. So these are the main reasons for converging the same. You may wonder, why was it converged and not implemented as a whole, right? That is because there are like a lot of problems when it comes to each particular standard, right? So each particular standard will not apply in every country because of varied economic environments and things like that. That's why there is carve-ins and carve-outs, which basically deals with the changes in the Indian environment. So these are the need for the global standards, because you'll be able to access capital quickly and you'll be reducing cost of compliance in other countries, right? You guys may be thinking, the thing is, in life, you need to pause on important things. Like guys, when they're scrolling Instagram, when they see guys post, they scroll through. If an article from their firm has posted, stop, like, share. So that's how I'm going faster, because the important stuff is coming up. So what is IFRS and what is US GAAP? IFRS is more principle based, while US GAAP is a little rule based. US GAAP is followed only in the US, while IFRS is followed in more than 140 countries. IFRS has less disclosures and less rigid, while US GAAP is a little more rigid, right? Now, again, I spoke about these obstacles and changes and why it was necessary to amend the same in India. Okay, now coming to the main part of my PPT. So these scandals became catalysts for changes, positive reinforcement and changes in these accounting standards, because genuinely necessity is the mother of all invention, because only when we see a problem, we'll be able to get a solution to that, right? So I'm going to be talking about the global financial crisis and the crash of the Lehman Brothers and how it led to the changes in IFRS 15 and IFRS 9. So guys, when I tell IFRS to get a subsequent Ind AS, add 100 to it. So IFRS 15 is Ind AS 115, while IFRS 9 is 109. But when I see IAS 16, it's the same. So if IAS 16 is PPE, the same as Ind AS 16 PPE as well. So what basically happened in the global financial crisis and specifically in Lehman Brothers? Let's start with IFRS 15. So in the US, there's a thing called Repo 105. In Repo 105, financial institutions can borrow money from the Fed by keeping their assets as collateral, right? So what Lehman Brothers did was, they borrowed a lot of money from the Fed and they kept their financial assets as collateral. But they recognized the same as revenue. That's where the problem came in. Although these were not sales, to show a better financial performance, they started showing these collaterals as sales. This led to a lot of problems, and eventually Lehman Brothers came cashing down. It was the fourth biggest investment bank in the world. When it became bankrupt, nearly 25,000 people lost their jobs. Now, what did it do? The more refined IFRS 15 came out in 2014, which talks about the following things: substance over form and control of transfer. What happened here was, control of transfer is a very important principle right now. Although these assets are being transferred to the Fed, that's only temporarily, but the risk and rewards are still with Lehman. So they shouldn't have recognized their revenue, and better principles came in, and substance over form. So the economic substance of these transactions is more important than the legal form that's happening, right? So this was one of the biggest crashes in the world, and it became the zenith of the global financial crisis. Now I keep talking about global financial crisis. Let me tell you what basically happened in the global financial crisis. I see a lot of white empty seats. So when you go outside, tell people I learned a lot, I learned like complex stuff you guys didn't know, right? So what happened in the financial crisis? Basically, US, like always, overestimated its power. in the housing market. People thought people will go on, keep on buying houses, and what financial institutions did was they started lending more and more mortgages. Mortgages are basically home loans. So when they gave more and more mortgages to subprime lenders, that is, subprime mortgages came in because higher rate of interest was being charged for people who are not worthy enough to get these mortgages. To reduce the credit risk involved in these particular loans, higher rates of interest was being charged. Not just that, the banks became greedy. As these assets were, these loans were assets, they started a lot of derivatives, that is mortgage-backed securities. So when these assets move, the mortgage-backed securities are derivatives of these assets, and they move as well, right? Not just mortgage-backed securities, a lot of other derivatives like CDO and CDS, that is credit default obligation and credit default swap, basically came in. So what they did was they started giving out bad loans, and they made a lot of things so that they can make money. Then the whole base started crumbling when people were unable to pay the EMIs and the installations of these loans, and the whole system came crashing down. A lot of banks had a crazy amount of exposure to these particular derivatives and lost a lot of wealth in the crisis. So now let's come to another change, that is in IFRS 9. How did the Lehman Brothers and global financial crisis influence this particular standard, right? The main criticism of the previous standard that recognized financial instruments was a lot of complexity and a lack of classification and measurement of particular assets. So one of the main improvements that came in was forward-looking expected credit loss. Expected credit loss is kind of a complicated concept. Let me break it down for you. So here you're getting married, right? That's a financial asset. And a chance of loss is you getting a divorce, right? So whenever you're getting married, when a financial asset is being recognized, you subsequently also recognize a credit loss. Basically, you estimate that this much loss is possible. So there are 3 stages here, stage 1, stage 2, stage 3. In stage 1 of ECL, you record a 12-month loss allowance, while in stage 2 and stage 3, you record a lifetime loss allowance. Let's come back to our marriage example. Your honeymoon period is over, you start having small fights, you start sleeping on the couch. This is stage 1. So what you basically do here is 12 months of your salary, you send it to your mom's account, because if you get a divorce, she'll take half of it, right? So send 12 months. There are chances of losses being incurred in the future. Then stage 2 and stage 3 is significant credit risk. That is, she going back to her mica and things like that, things escalating, she sending a lawyer. What do you do that time? Lifetime ECL, you send it to your mother's account, because if you have 10 rupees in your bank account, let she take 5 rupees, right? So at the end of the day, the basic concept of ECL is to make sure that you have loss allowances to cover the changes in fair value of these bonds, right? Derivative accounting, as I told you, mortgage-backed securities and many other derivatives were formed, but these were never accounted. They were just shown in the notes to accounts. So IFRS 9, which was amended, made sure that these are accounted in the books. And also comes hedge accounting. Hedge accounting is again the same thing. Hedge accounting has 3 types of hedges, that is fair value hedge, cash flow hedge, and international operations hedge. So again, in hedging, when you recognize a particular asset, you make sure that you hedge the same. The problem with this is the hedge accounting is optional. I'm going to come back to this problem later, right? And another change that came in was held for trading liabilities and shorting. Basically, when a financial institution shorts a particular stock, they make sure that the same is classified as fair value through P&L. So fair value through P&L is basically you record the asset and you make sure that when there are changes in fair value, the same goes to P&L, right? Now the next scandal I'm going to be talking about is the WorldCom scandal. So what happened in the WorldCom scandal? Let me tell you what happened. WorldCom was a really big telecommunication company at that point of time. So what they did was in the early 2000s, their financial performance started coming down. So that to give a better picture and to stay viable in the whole investing environment, what they did was they started capitalizing revenue expenditure on assets. So by doing this, these revenue expenditures which had to go to P&L were capitalized and the assets were overvalued by $11 billion, which led to the bankruptcy of WorldCom, which was one of the biggest bankruptcies the world had ever seen. A nearly $80 billion loss was incurred when the company went bankrupt, right? It was not just initial recognition, they capitalized revenue expenditure. Even in subsequent recognition, they didn't depreciate, they didn't impair their assets. So after the changes, just after the scandal in December 2003, IAS 16 made a lot of changes where it tried to explain what are subsequent expenditure and how can it be capitalized, what needs to be depreciated, and the estimation of the same, and it ensured that there is better disclosure so that the same doesn't repeat again, right? Now the third scandal I'm going to be talking about is the Enron scandal. So Enron again was an energy and a commodity trading company, and they did a lot of cooking of books to make sure that they keep getting the whole nation's attention and the whole nation's money. So one of the they impacted a lot of standards, and one among them is IFRS 10, that is consolidation. So off-balance sheet treatment of SPEs. SPEs are special purpose entities. You guys may be thinking, "Uta time agide, bike bandang matartiya na you." Let me just break it down for you, right? So in college, you have 5 friends. But when you're posting on Instagram, it's only the 4 of you. You guys go somewhere, only the 4 of you. You tag only the 4 of you. But there is a 5th guy who does all your homework, who does all your assignments. If you get caught talking, you blame it on that guy. That is basically special purpose entities. All the losses, all the debts were being transferred to these special purpose entities, and they were never consolidated in the financial statements. Basically, you write off the losses to these particular SP and just remove it from the books, right? When it came to global picture of what this happened, again IFRS 10 was later amended, and the amendment came pretty late in the 2010s, where IFRS came out with IFRS 10, 11, 12, which deals with the same. And another thing they violated was mark-to-market accounting. They basically violated fair value principles, right? Again, fair value principles were made sure that the new changes that came in IFRS 15 was also tackling the same. After these major scandals, the US GAAP made sure that they moved more towards principle-based than rule-based because of the scandals happening only in the US. Classic Americans starting either wars or scandals, right? Now, what do you see in the picture? You see Signature Bank, SVB Bank, KPMG and Andhadhun. You know that these 2 banks collapsed, but what about Andhadhun and KPMG? KPMG was the auditors of these 2 companies, and they pretended to be blind when these things were happening, right? So why did this happen? I'm going to talk about the same. Now, basics on economics. When interest rates rise, prices of bond falls. Okay, so here you can see in the picture, since the time of the pandemic, when the interest rates in the US was 0, and right now it's around 5.5%. So when this much interest rate increased, the bond prices also fell, right? So that's what happened here. Now I'm going to break down how financial assets are basically accounted. Imagine you're an accountant of MS Dhoni, and you see on his wrist a Rolex GMT Master 2. He bought it at 33 lakhs, and there are 3 ways to account for the same. First one is amortized cost, second one is fair value through OCI, third is fair value through P&L. In amortized cost, you record the same at 33 lakhs in his books, and you make sure that you don't change it. Although the fair value may become 40 or 20, it's still 30 lakhs in the books. But in fair value through OCI, if there are any changes, if the watch becomes 40 lakhs in the market, the 17 lakh rupees will go to OCI, and later it will go to the P&L. The concept of OCI is very simple. When parents create an FD in your name, although the money is yours, but you only get the money when there is a time of need, right? The same thing, OCI can be reclassified to the P&L only when need arises. So fair value through P&L is very simple. If the price goes to 40 lakhs, you record the same in P&L. If it comes down to 20 lakhs, again the same needs to be recorded in P&L. So what happened in our bank's cases? Again, IFRS 9 has told these principles, and what these banks did, they recorded their whole investment of around 90 billion US dollars in amortized cost. The interest rates rose, the fair value of these bonds fell, but the same was never disclosed. The first disclosure came in December 2022 when SVB Bank told that as there was a run on the bank, basically people started withdrawing money from the bank, they had to sell these investments at a loss. And that's why the bank collapsed, because everyone panicked and removed all their money from SVB, but they didn't have the money because they had accounted through amortized cost. In the balance sheet, it said 90 billion, but they only had 76 billion actually. So that's a major problem. After this, CFA has written a letter to SEC and both FASB to stop using amortized cost principles and use only fair value, because in amortized cost principles, management intent is extremely important, and management intent may lead to scandals like this. So they make sure that only fair value is represented, because fair value is what investors want. They want to know how much money the company has in its books as per the market, and that's why there's a chance in the future that you may see amendments in IFRS 9 regarding how assets are classified. I would like to end by saying we as auditors shouldn't just follow accounting standards and auditing standards. Set a standard for your life and live by it. Thank you.
Thank you so much, Sudarshan Iyer, for those valuable insights.
I would now like to request CA Rajavardhan, the session chairman, to conclude with his closing remarks.
Ladies and gentlemen, give it up for CA Rajavardhan.
I get it that you people are hungry and few of you are leaving. People who seated and then heard them throughout, thank you on their behalf, because they did put in a lot of effort, way much than what you guys can actually see right now. So they do deserve another big round of applause. And I would give you my concluded remarks on all the three topics. I'll keep it really short. Trust me, I will take lesser than the time that you take to make a Maggie. And to start with, when Sri Gauri walked us through the entire thing, towards the end, the AI part, when it came down, it became a little short of time, and you people are also a little impatient. So just to answer on that part as to will AI replace us, the answer is, they did mention about XBRL in the entire session, if you people did heard. So XBRL is Extensive Business Reporting Language. For a really small entity, when you file your company returns at the end, you have a file which is like PDF, which you download from MCA website, do fill in the details, validate, and then upload it with digital signature. However, all of these details are very much valid and required for the government whenever they announce their budget in the month of February, which previously the minister used to get with a brown color briefcase. Now you would see a red color lifafa, which Nirmala ma'am gets every year. Have you guys gone through this? Have you guys seen the same? We're very shortly awaiting another budget. So whenever this lifafa comes up, and in that, when the finance minister of the country stands there delivering a speech telling us the automobile sector has improved by 10%, the IT sector has gone down by this much, so FMCG sector is performing this way, they do come out with these numbers based on the reporting that's made by the company. And just imagine the number of companies that's being incorporated in the country, number of returns that the MCA will receive every day. Just imagine how much of consolidation work needs to be done by the finance department to come out with those figures as to how is each sector doing. To simplify the entire structure, for an entity with a specified amount of turnover and specified amount of profit, you need to fill your returns not in the regular, the file that you file in PDF, but you need to do something which will look more like a spreadsheet and less like a PDF, and that's XBRL. And from XBRL, extraction of data becomes way more easier for the finance department. And those of them in the crowd who's done XBRL reporting before, can you give me a cheer if you have used XBRL before? Those of them who've done it understand the pain of doing XBRL. After you spend 3 good days looking at the audited financial statements, filling up the entire XBRL form, and at the end when you press the button validate, it comes up with altogether 100 errors which you need to address one after the other. And we are wondering that AI might replace us. AI has made our life more simple. Those 100 errors are generated by AI, artificial intelligence. If in case there was no AI, then we were supposed to do the entire consolidation manually. We were supposed to identify those errors all by ourselves. At least AI does the job of identifying the errors, leaving us with only handling those errors. So AI might eat away a lot of jobs. I'm not denying it. But if you look back 10 years ago, there are a lot of jobs that are there in the present day which no one ever thought there would be a job of that type. Similarly, 10 years down the lane, when AI eats a lot of our jobs, there will be hundreds of new jobs which will be created which we can't even imagine right now sitting under this roof. No one ever knew that someone will sell a course telling how to get likes on Instagram. But they're making crores of rupees today, and no one ever knew that people would get advice on finance, advice on taxation in a 1-minute Instagram reel. Now people end up watching Instagram reels for more financial advice than they're going to a chartered accountant for advice. And we also believe that everything that we hear is true until and unless we receive the report where we actually end up going to the chartered accountant at a later stage. So that's my conclusionary remarks with regard to what Sri Gauri did cover. She covered it very nicely, bringing in KGF into picture, telling that history was, So what I would tell is, yeah, we can write lot of replies to our letters by ChatGPT. But I would also reiterate a part of KGF, which tells like, ಯಾವಾಗಲೂ ಕಾಲಕ್ಕೂ ದೊಡ್ಡವರು ಸುಳ್ಳು ಹೇಳ್ಕೊಂಡೇ ಬಂದಿದ್ದಾರೆ. Yeah, and ಅವರು ಇವರು ಬರೆದಿರೋದನ್ನು ನಂಬೇಡಿ. New was not having any margin of error to get into private placement, and there was no time frame applicable for the same, and they had not mentioned any number as to what extent is it private placement and beyond what extent is it completely IPO. So 19,000 crores of money by private placement. So that was question. In fact, SEBI turned out to be the one with the upper hand. They slapped a notice with 12 crore of fine just because of delay for those fully convertible debentures issue. However, right after the Subrata Roy's case was done, as expected, SEBI had to amend the provisions and make it more clear to differentiate between private placement and our public offer. Otherwise than that, he gave us a very beautiful understanding of how exactly did the changes in the Companies Act come into picture with regard to rotation of auditors for what happened because of our Raju. I was worried if he's referring to me when he put that Raju picture and I was standing right behind him. But gladly someone from the audience did mention that it is Satyam and it was about Ramling Raju. And coming to the last part, wherein the man from the global world who they basically didn't take us to the accounting world at the national outset, but took us to the international outset, took us to a US tour, and then did mention about the Lehman Brothers. So the entire Lehman Brothers scheme, as I was mentioning in my opening remarks, happened in the year 2008 when a lot of us were in, sorry, not me, many of you people were in Cradle, in fact. So talking about this scam, Lehman Brothers evolved over a period of time, like how accounting evolved. It will be surprising to you if I mention that Lehman Brothers initially started as a company dealing with, cotton. They were trading with cotton, they went on to coffee, then they actually got acquired by our American Express. And by way of a spin-off, it came out and then it became an investment bank. For many of us who don't understand investment bank, in simple terms, it takes care of our underwriting and then debt finance issue and quite a lot of other things. And that point of time, there was .com issue, .com companies and several other things because of which US markets were not doing great. And at this point of time, our Lehman Brothers noticed that real estate sector is going to be the one that's going to be the future, and they started venturing into, the real estate sector. I don't know how many of you in the crowd have seen this movie of Badmash Company. If you can see the Badmash Company, the last scam, what he does, which puts our Shahid Kapoor to jail, is the entire scam of Lehman Brothers summarized, wherein they buy a property completely under the mortgage scheme that we don't have in our country, sell it to another person at a quite higher rate. The value of the asset has gone up in the books of mortgage, but the actual value of the asset is much lesser. And when the interest rates went much higher, the value of the asset that they had as mortgage was much less. So people found it way more simpler to skip paying the mortgage and then let the asset go to the bank's hand. So that was the point of time where bank had more buildings than the money in the bank. So this ended up and then turned out to be the biggest downfall in the US banking history. Just to tell you the expectation, just to tell you the extent of this Lehman Brothers scam is, if you list the top 10 banking scams in the US, and you take Lehman Brothers coming on the top of the table, number 2 to number 10, if you sum up the entire amount of scam amount, that doesn't even come close to the amount of scam amount involved in Lehman Brothers case. It was about $631 billion. I'll take last 1 minute. Yeah, I'm sorry. And that's it. I wouldn't take much time. My conclusion remarks is that we've been hearing all day saying that ours is a very large economy and we're heading towards going to become much bigger economy, $30 trillion by some specific time. So the way ahead to reach there is something that we all know, that ICAI is the second largest economy in the economy across the globe, in the global accounting body. So to make our country much merrier, before we become the largest economy, we need to become the largest accounting body in the country, and that's the way to go forward, is what I believe in. I heard a great man say that the future generations will put us to shame. I hope you people will put all of us who are here today, who don't belong to your age group, to shame, and then do a lot of things for the country what we only dreamt of. So we'll be waiting very eagerly before I go to the graveyard to see our country mighty and then being on the top of the table when it comes to the economy. So thank you all for your pleasant listening so far. And before you head towards your lunch, I have one last question for all of you. How was the session and how are our paper presenters? Did you people really learn something in this session? Did you people also have a little fun with fun, cute memes that they did post? That's it. Remember, life is not a battle to be struggling. It's a game until the time you're in the game, and the one who lasts till the end in the game will turn out to be victorious. I have one last question for all of you people in here. Are we in the game? Yes. That's it, guys. See you all in another stage. Till then, have a great time. You people have been lovely audience. Thank you.
Thank you so much, sir. I request Chandra Prakash Jain, MC member of Bengaluru branch of SIRC of ICAI, to give memento to the session chairman and the student speakers as a token of gratitude. A huge round of applause for the session chairman and all the paper presenters out there. Harshita Gata, a member of SICASA Bengaluru. Thank you so much, sir. A huge round of applause for the session chairman and paper presenters.
I would now like to request Harshita Katta, member of SICASA Bengaluru, to deliver the vote of thanks, thereby winding up the session.
Feeling gratitude and not expressing it is like a wrapping a present and not giving it. Today, I, Arshita Katta, stand on behalf of SICASA Bengaluru with a heart filled with a gratitude. As we come to the close of the first technical session, I would like to extend my heartfelt thanks to session chairperson C.A. Rajavardhan and paper presenters Shri Gauri T.R., Pajanya Achar and Sudarshan Iyer for the wonderful presentations. Thank you.
Thank you so much, ladies and gentlemen. As it is rightly said, खाने का स्वाद दोस्तों के साथ, खाने का स्वाद दोस्तों के साथ, यही है वो लम्हा जब दिल से होती है बात. Ladies and gentlemen, let's break up for a lunch break and quickly rejoin at 2:15 p.m.